Hello. Good afternoon. Welcome to another ES Futures Trading stream. Today is Sunday, November 12th. It is 1:56 p.m. Eastern Time in the US. This is Victor streaming from Atlanta, USA. What I'm going to do, this is kind of like my market update for the upcoming week. And what I do usually, I review what happens or what happened in the week and what is the state of the market. And what I usually do is I go first and check my bigger time frames, right? This is the first thing I do after the market close. No, actually, this is a chart. Sometimes I keep open all the time. I keep it open all the time last week because it was very close to a breakout here from this level. We can see this is the monthly, weekly, and daily time frames. We can see in the monthly time frame the market trending lower, one time frame lower. Penetration into this range, it's at this 13-month range, but it did not have continuation here. It took one low here. When the market fails to take this low, there is something that can happen there. It did not have continuation when this month opened. The continuation would have been taking this low first and then this one. It didn't. The first thing it did, it come back first inside this range and then outside this range. And the next thing is taking the previous month high, which ends actually. This action ends the trend to the downside in the monthly time frame. And the monthly, because it's the bigger one, is always the last one to show change. Now all time frames now are in sync. We can see the weekly is trending higher. You have one time frame higher, but lower here. The first bar did not take this low out. Previous week did not take this one out. Actually, it is a very narrow range here. An upside continuation here. In the weekly time frame, we'll see the market taking this high out. Now the market is back inside this range. We have this range here. Yes, what is 1, 2, 3, 4, 6 week range we have here. Now coming back inside this range targets the opposite. So it is the same principles, the same guidelines that I have when the market re-enters or gets out of this range, for example, that I apply when the market has a breakout from this range, it comes back inside. There could have been a breakout here, look above and fail, which targets the opposite side. It didn't, right? But I have here is continuation. But this is what I apply here is balance guidelines. There's a breakout balance, then comes into this bigger balance, 1, 2, 3, 4 week balance range here, and now the market has reached the opposite side of this balance. What is for continuation? What's the next thing for continuation? This other range, right? And all of this one, this range here, this bigger one here is inside this bigger one, right? What's happening? Can you see the sequence here, right? First balance, first range, second range, third range, and the bigger or the ultimate destination is this bigger this trading range, maybe 20 days, something like that. 1, 2, 3, 4, 6, 8, 10, 15, 20 day range here in the weekly. I am paying special attention to this time frame, the weekly, because it it is the cleanest one. It is there is a stark difference between the daily and the weekly. The weekly is kind of like more the development in weekly is kind of like the smoothest of all these three time frames. Now, having this in the monthly, have described the weekly, now I go to the daily. Right? When I go to the daily, what I have here, this is the adjusted chart, right? The adjusted chart. We have this three, the break that happened here was really bad, right? Really bad structure. In a market that has a terrible structure to the upside, all of this rally here, it didn't have a really solid structure to the upside. This is terrible here. You know, we have 1, 2, 3, 4 gaps, 5 gaps, something like that. A lot of gaps, you know, which is a sign that that is a market that's hyperextended. We have this, you know, you can see this late stage of the market. Multiple lows, buying coming from the 50s, buying coming from the 6 or the 100, buying coming from the 200, moving up really bad here. And this is the laggard stage of this market. And this is something that you will see quite often, right? But the thing is, there are no 2 days that are the same in trading in the market. No, every single day is different. Now, the question is, if every day is different, why you will trade the same way? Okay, that's one reason. That's another reason why I don't have these setups, right? I don't have these things that strategies for the market or fixed strategies. There is always I try to put things in context here, but there are similitudes. There are similarities within days. Now we can have this really bad market here, for example, going to the upside. At the late stage, you can see this formation here. Really nice trend line, right? Market being bought from every single time, bought from this from the trend line. This behavior, this dynamic, also happened here in this day, in these days, or the past week. You got the market being bought from this level here, which is indication. No, I hate that word. I don't like that word, because if I say it is indication of that something is happening, kind of like I will be assuming, right? I will be assuming that I know what's happening. But the odds that this is a late stage, the laggard stage. Remember something, you know. Remember the diffusion model. The diffusion model is something like this, right? This is known in statistics as a diffusion model. If you have data or anything, you can divide the market in 4 stages, 5 stages, right? You can divide, or one trade, you can divide a trade in 1, 2, 3, 4, 5 stages. The first stage is the innovators. The second stage is early adopters. The third stage is early majority. The fourth stage is late majority. And the final stage of a trade, which is what I am interested in. You can apply this to any other kind of data, right? It's the laggards. Any kind of business also, you know? The innovators, all them can win and can lose here, right? The innovators, it doesn't are the first ones that enter the trade. In this, if I am going to take, for example, this trade here, if I'm going to take this trade here, this example, this area here, right? this thing here, this area could be maybe this part, could be the innovators here. This part could be maybe the early majority, the early adapters. Early majority and late majority can be like all this here, and the laggards are these as we spoke a couple months ago. We talked about a couple months ago, right? If I take this trade, there are two trades here. There's one trade that use this, that can be that trade, another one that can be this one over here, right? Early majority, who knows, maybe this part here, right? Maybe this part here. My bad, the innovators here. The early adapters could be this area, this section here. It is easy to do this, right? It's easy to do. Early majority, late majority, maybe this area here, right? And the laggard part of this trade, as Jim properly highlighted, this could be the laggard part of this trade could be the innovators of this one, right down here. Because the market is a constant two-way action. It's a two-way action that never ends. Most part of the time, or most of the money, is made in this area. In this area here. Early adapters, early majority and late majority, which in our case represent 70%, which happens to be, it's also, that is also the value area. 70% of the activity or this distribution curve, or this area that is underneath this line, and the same percent is down here. And this represents the extremes, the extremes, these sides, and these sides are the extremes. Most of the money is made in this area here, in trading. And to highlight the similarities of this trade, what we have here is what we had here last week. You can see, right? The same behavior that we had here. You could place a trending line here. Basically, you can put a trending line here, and the same thing happened here. Both being bought exactly from that trend line. And those things are observations that we do, and we need to be present in the market to see so we can assign odds to whatever action the market is doing. Right? One of the first things we as traders need to do is understand what the market is doing, rather than trying to guess what the market will do. Is what the market is doing, and last Friday that was key. There was something. I guess last Friday was a clear example of that. Right? Before going to what happened on Friday, we have this. Right? We have this break that you can find something, find some sense when you watch this side of the market, this part of the market. Now, I notice, to trade, to do this trade here, to do this break here, to trade this market, we need to be aware. We need to understand what happened before all of this. How much time? Well, since March, right? Okay, no, since March, since June. You take your number. Now, but you can do something here. What you do here has a lot to do to what happened here. The base, the fundamentals for the trade here, for the break here, is what we have here behind, way behind, right? And this is information we carry. I don't know how much time I'm going to carry some information, but until it's useful, I will keep carrying. This break was a horrendous break. Really, if this rally was bad, this break was even worse. And if this was worse, this one, I don't know how to call this. That's even worse, right? This structure was bad, and this was even, worse than this. The rally that we are having here, really, really bad. Every single low was weak. Weak, poor, non-excess lows, mechanical lows here, multiple gaps here, 1, 2, 3 gaps here, and then you have this potential, the firecracker effect up here. Really clear the late stage of trade, but the fact that one market is weak, it doesn't mean it's going to break. We also have to be aware of that. And a lot of money is lost. We lost a lot. We lose a lot of money when we try to upfront the market. I know the market is weak. This has to break. It's too much, so I'm going to be short. And when the market has momentum, momentum is something that can move markets to extremes. This market can come back all the way up to here, can make a new high. We never know. What is going to happen? I don't know. Nobody knows what's going to happen. Nobody knows that. And that was what happened last week here. There were signs that this market was hyperextended. And when we had this thing on it was Wednesday coming into Thursday, there's something that I have noticed here. I also have these charts. This is the non-adjusted contract, and this is the current contract. Okay, I have several charts of the same thing. Notice this is the daily of the market without any adjustment. Well, you just took the market. You take the market, and when there's one change, when the contracts change, like it happened in September, for example, something like that. If there is a gap, this could be one contract here, and this is the last day of one contract, and the other contract, December contract, can be. I'm not saying it's that, right? But can be different contract. So these two charts have nothing to do between each other, and that's why I have the same charts for different charts of the same thing. In this case, the years. I have the daily. I have the adjusted. My bad. I have the adjusted contract. Notice here how many gaps do we have, right? For example, 1, 2 gaps in the adjusted contract. If I check the non-adjusted contract here, where these gaps are, 1, 2, 3. Notice that the market closed this gap, and took this, was bought from these lows. You got 1, 2, 3, 4, 5, including that. But if I take the adjusted contract, these lows are well behind. This is not a reference anymore. In the same way, I also have the current contract, just the current contract, which is this one, right? Notice, right? This is last year. This contract has pretty much nothing traded, and it started to trade heavily, I believe, here, right? This day here. In this chart, I have noticed when the market was giving us this potential for firecracker effect. I have this, I just put this line here, and I did this because the market was trading mechanically, very mechanical. You can see this is mechanical trading going on here. That there was some potential the market being sold from this level or being bought from this level. None of those things happen. Okay, none of those two things happen. So I keep looking, and I came back on Friday to this chart. You know, this is a non-adjusted contract. Okay, I will come back to this. Right? I will come back to this chart after we review the market profile. We got the market profile. You know, we got 1, 2, 3, 4, 5 days before Friday in range, with Thursday taking all these lows out. You know. This was a mechanical weak level. This was weak as well. Non-excess here, mechanical level, poor and weak. No, it was weak here. I don't know why I call it, but every single one was weak. Now we have Thursday that take all these ones. We have no excess in the lower side, you know, which is a sign that the trade has not been completed. The action to the downside has not been completed here. Also, it was bought from this level, the same level. Oh, so it's a weak level. It is poor and weak at the same time. Okay, and what is the information? What was the piece of information that I was carrying on from the past? I had I cannot see more. Oh, okay, I guess I had to do this. Okay, I was carrying this high here, right? Because there's the same thing that we had here when the market breaks and take these lows. We have break out of this inside bar, inside day, you know, value outside. No, look at this. Look at the formation of this day. This looks like short calling rally, right? Short calling week is the market. This is the classic P formation. It's not perfect, right? But what catches my attention is the lack of excess. It has excess, but notice how many times it was bought from this level. The next day we had the same thing, right? Even though we have a break, you know, the stops that we have here will move just higher here, kind of like average. I could say maybe average. Remember, it's easy. On hindsight, it's easy, but we need to see this information. Doing it in real time is the thing, right? This day, opening outside of this range, this trading range, 4-day trading range, 2-day balance. Here we're coming from a breakout. Michael just didn't care, right? And all this long has been liquidated, but it leaves this high. You know, the market just coming. Something that we were checking or talking was that, you know, traders may think the following. We may be thinking the following: the market is not going to come back all the way up to here just to be sold from this level again. Non-excess here, gap here, there's nothing on the upper side that can hold this market, you know. And after this liquidation, we have Friday here. The same kind of opening that we have on Thursday, the same kind of opening we have on Friday. But the context was completely different, you know. Same kind of market opens and start to sell, and start sales from the opening here. I still, at this moment in time, you know, I was trying to assess, or we try to assess what is happening. Before trying to guess what will happen, most important is to try to understand what is happening. When the market, and the way how this market was just getting short here, you know, it was painful to watch this. I almost fall asleep. I guess I was streaming here, and when I called the stream, I called the day, I was just falling asleep. And one of the things that we talk I was talking here is that when the market puts me to sleep, but I think that's a sign that something may happen. Something may happen. Um, Up to this point here, we have this. The market just rejects, you know, the trend. It ends the trend to the downside. One time frame lower. One of the guidelines we have here when the market opens, look at where the market opens, right at the center. The closer to the center, the higher the odds chop, the higher the odds of rotation. And this was expected rotation. The next thing after this is respect rotation, right? That was still always expecting rotation, but the market gave us an inside bar here. Inside bar here. Volume was absolutely, really bad here. Notice how this market, up to see how this volume drops here, right? Volumes drop. It starts to increase a little bit relative to the previous period, not to the previous day, but to the previous period. It increases a little bit, but it's very low here. So at this moment in time, market was buying from halfbacks. If you see the intraday, if you can replay this day, you will see that. And this is when one of the things that I was talking during this day is the last thing I want to do is a long here in this market, especially coming from this having this low on the previous day. But another thing that I was kind of like joking, right? As soon as you or as soon as I just make a decision to not to be long, I find myself being in the long side. I mean that as a joke, right? I got this formation here, and so the 4400 is right there as well. The 4400 is right there. This is a level where if there's any problems here, if the rally is going to have any struggles, usually it's going to happen around this level. And here is when observations comes to play. There was a lack here. There was a lack of serious, I can call it maybe serious money. There was just short time framing. Short time frame trading was dominating the market here. One of the things that I have observed, let me see if I can pull this during this day. Okay, I guess there could be there could be the long can work here, that's what I say. We talk how this area, the market has these two areas, the volume. So the previous day, here, up here, and down here. It tried to get to this area, it didn't get even close, right? It didn't get even inside. It just didn't. So the next thing is, when one trade fails, trade is focused on the opposite side, which was this one. And what else do we have here? The 4400. Okay, so the odds here still were low here. But this is when I start to watch, okay, I think, because short-term trading is, one of the characteristics of short-term trading is they don't care about context, because simply they don't know the context, what's happening. But I thought it could be a good opportunity for this market, that the ultimate destination of this trade could be this high here, taking these highs. And that was clear, but the picture started to get clearer after the breakout we have here. You have this breakout or this inside bar, and the breakout happens to the upside in the direction of the trade, in the direction of the trend as well, right? Sometimes you just have to disregard something in favor of another things. Many times we focus on what is against our trade rather than what can favor, what is behind our trade. And once, this is one potential entry here. and the exit or the stop of this trade is the opposite side of this inside barrier. Not that much, 5 points, 6 points, 6 points, if it's something like here. And you can see it never came even inside, back inside. The other opportunity for this trade, I have to say that the risk on this trade was high. Okay, was high. High risk trade. The other entry location could have been this high here, when the market breakouts of this range. When the market take this range out, and you would see here how this market was doing, right? By the book, once you figure out the market, that specific market, it doesn't work all the time, right? We need to understand that thing. There are cycles. Markets work. End of the years are different than the middle of the years, the beginning of the year. That is not always the same. But once the market has one behavior, there is some potential there's something there that can increase the odds or something. This trade was very risky. And the context, something else that I had from Friday, is the market had a big break the previous day. Okay. Now we have Chairman Powell speaking here at 2 p.m. And the market just, have a gigantic break here, something like 10, 20 points in like less than 5 minutes. And traders were, the longs were burned here, were killed here, okay, this day. These traders that were killed the previous day were very hesitant to be long on Friday. That's one thing. Another thing that is end of the week. We were talking that one of the strategies that is heavily used, but short-term traders is also naked options selling, right? What would be the tendency? What are the odds of traders selling naked puts here when the market is going high? They see the market going higher. It's high, right? End of the week, especially. End of the week, the market's up here, never going to come back here. And just one day before the week ends, it has a gigantic break, and those puts, I think those kind of traders or trades were badly hurt that day. Something that happened, again, context, right? And this happens, this can happen. There are so many things that happen in the market, right? Once you got the calls, once you had the puts, because there's supply there, and market don't have continuation, what else do we have? What else do you think a trader can think when they see this gigantic break, having this market? Oh, okay, the market is going to break, right? So I'm going to sell put up here, a call. Then we go for the naked call sellers, right? The naked call sellers, the options, naked option sellers that were selling this market, just 1 week before. The market is never going to come back up here when you see the market going this far. That's another thing that we can also think about, and I believe that has something to do with what happened Friday as well. That piece of information, that little piece of information, it started to play, right? What if, right? That is what's happening in this market after this break. Traders were going to be very hesitant to be long after witnessing this break here, aiming to this high here. I say, okay, let's take our chances here, but understanding the context, okay? Understanding the context, because this rally is one of the worst that I have ever seen, and let me tell you why. This trending day, look at where this low is. Right? Exactly previous period hardback. It has no taper. Right? It don't rise here. Notice that there is something. Notice how this is tapered here, right? You have volume a little bit less and less and less and less up here. It doesn't have anything down here. No, it doesn't have anything down here as well. There's no. This is not tapered here. I don't see tapered here in this low side. I see something here, but where this market is bought, hard back. All right, inside bar, breakout. Where this market is bought from this high volume area, there are longs here, right? They're buying at the really high prices, at very top. The highest prices. That's where they are buying. Remember, from our distribution curve, remember this concept: innovators and laggards. Laggards doesn't always lose. The odds of this trade, taking these trades to being successful, are low. It doesn't mean they are going to lose all the time. And I believe that was the case, one of the few cases that happened. Because what happens, this is behavioral conduct, this is human behavior as well. If you have an odds, you do something, okay? You take an action here. And you can have several outcomes of this action. 100% that is going to do something is going to happen, 70% is something is going to happen, 50% is going to happen, all the way down to zero, right? This is human behavior, it's animal behavior. This happens in all animal kingdom. If you have something that you win 100% of the times, the next time you lose, or if you lose 2 times in a row, you won't do what you were doing here, right? And if you lose all the time, you have 1, 2, 3, 4 losses straight. You probably will abandon this also. You won't do this, okay? You don't do when you take a couple losses here, you abandon this behavior, right? But if you would have something, every 10, 15, 20 trades, whatever, you take one win, you will keep doing this again, 15, 20. You can have it. This is amazing how we behave. We can have 50, 100, 150 times doing the same behavior and losing. But if we win once, that's enough. That's enough to repeat this behavior. That's what's happened with lottery games. Okay, scratch lottery games or stuff like that. Lottery games usually. What are the odds of winning something? They're really low, close to zero, right? But we see in television, okay, this guy won $1 billion, right? But we don't see. The information is there. How many people have entered the contest? Right? How many people? How many times? They're doing the same, but we just don't. We close our eyes to that information. We choose to see only one part. This is a bias as well. This is called the survivorship bias. And then when we have this distribution curve, this section of the market, the laggard stage, doesn't mean that it's going to lose. Just the odds, the odds are very low here that happen. Friday, I believe it was one of those cases, right? Because look at this, buying from hardback. Next thing, buying from hardback again. No taper on this. Again, in this period, buying from hardback as well. Again, look at how close these lows, these periods are being bought from. Really close to the low, really close to the low, really close to the low. The same behavior that we had here, but in another time frame. This is not the daily what is happening here. This is the intraday. And when the market started doing this, God, man, it was clear here that the potential destination could have been this area in general. No? Now, where I started to think, well, where this market can be sold from, where can it stop? And that's when this chart came to play. That's when I noticed where this low was. This is the 50 moving average, and the market was heading towards this, towards the 100 moving average. Okay, this is why I decided to short the market up here. Going into the weekend, and what are the odds somebody will want to go long over the weekend, right? Especially in this kind of market. I decided to short the market here. I found this level, understanding the context, okay? Understanding the context here. I decided to short the market here. I just placed an order, limit order here and sell the market. I sold a couple, like 4 or 5 times from here. And this is rotational market, hybrid market, and not trending in the second part with good odds of rotation. The rotation didn't happen, but I started to sell here. Rotational days, you trade at 1, 2s, 1, 2s, 1, 2s. I trade like 4 or 5 times here, and that what I did with that, I cannot go short over the weekend or long. I cannot hold position. I don't hold positions overnight. But something that I can do is get some puts there. I can, one position. I got one SPY here. I can hold SPY. But what I did, I thought maybe they were good. Those the market can close at least a couple distribution when I was shorting. I bought some about the put around this area here in the SPY. With the expiration, 2 Fridays, not this Friday, but the next, the Friday after. What's going to happen? I don't know. All right? But what the market needs to do, or what the market can do, that's the thing, right? The market upside continuation. I see that this is a trade based on the lack of, and the structure of the market here. The market can close the gap. There's nothing here that can hold the market. The market can come back all the way up to here. If the market gains momentum here, no, that's a trade not working. And when you are right, you are lucky. When you are wrong, you did something wrong. You need to trade. And the lucky thing was we got this downgrade of Moody was downgrading the economy, the U.S. bonds, and I guess the market has a break here, but they didn't get back inside this area here. Right, that's a first sign of the trading may not work. But the structure of this rally is even worse now. Notice how many distributions we have on Friday, right? 1, 2, 3, 4, 5 distributions on Friday. Volume, really low volume on Friday here. We had 9 out of 9 lows that were weak. Now we have 7 out of 7. Okay, because this low, this is a weak low. Yeah? Because why I say weak low? It's a mechanical reference coming from the 50 moving average or current contract. This is the adjusted. But this I call this a weak level. This is not a good one. Still, I am aware of the structure. The structure of the market is weak. It doesn't mean the market is going to break. No, we don't have, because when the market has this kind of contest, that kind of weakness, it needs something, something external, some catalytic that triggers a liquidation here. Chairman Powell saying that the economy, that the Fed can maybe is not done rising rates was what gave us this liquidation here. All of these loans are out now, right? That was another piece of information for Friday's rally as well. Sometimes the market gets too long that it needs to break before it can get higher, because it can continue to go higher. Right? That's what the market did on Friday. Another thing that happens also is traders see the market going that higher, and they just think, oh boy, this market is too high. It cannot go higher anymore. It's too much, right? But you see the contest. When you see the contest, you see actually some potential there, right? The liquidation of this inventory, the closeness of this area here, the lack of excess in the upper side here. Now these loans being removed, now the market can keep going higher. Shakes the market, shake the loans here, and so it can keep going higher. This also can be a shake, This can be the market shaking the shorts out. How do I know that? I don't know. I don't know anything here. But that's also some piece of that's market generating information, right? That's something that may be happening. I don't know with certainty, with complete 100% certainty what's happening. I try to understand what's happening here. The odds or the risk in the long is high, right? It doesn't mean I'm going to be sure. It doesn't mean that I am not going to take a loan. I need to understand context, and that's what this being a discretionary trader means. If I see something, I can do something based in the context of what's happening. That's what I do here. Now, going into the upcoming week. Okay, what do we have for next week? This is my calendar. Okay, let's check what we have here. Come on. I don't have, this doesn't have updates. I will need to check this tomorrow. But I do have another one. That's why I have, that's why this trading economics come handy. Impact 3. This week, start November 13. What do we have for this week? Core inflation. Oh, okay. Tuesday we have CPE on Tuesday. One thing. PPI on Wednesday. Okay, nothing else. Just those two things. What about earnings? What kind of earnings do we have next week? Something that can impact the market, that have some impact in the market. Okay, here it is. All right. This is for next week, or for this week actually. We got Home Depot here. Target here, Walmart here before the opening. What else? Am I missing something here? Highmark, Sigma, Cisco, kind of like consumer. Macy's here, Gap here, kind of like in the consumer side, right? Let's see what this I guess Lowe's is the week up. Do you have Lowe's here? Maybe next week is Lowe's. Okay, but in the consumer side, this will be something to see how the consumer is reacting. We have consumer sentiment that has decreased last week as well. So let's save this. Let's save this, and then I'm going to put that into my homework so I can check. I need. We have CPI on Tuesday and PPI on Wednesday. All right. I need to check my economic calendar as well tomorrow. Okay. So those are oh yeah, notice how many speakers we have this week. They all have a bunch of speakers this week, like 15. Last week, I don't know how many are we going to have this week. I don't know why they don't update this. Okay. I guess Tuesday is the most important day for what I have here. The gap, the market has closed. No, taking half of the gap. What do we have here in the upper side? Let's see. This is too much time far back. Just too much data. Okay. All right. Okay. What is this? This is one. I guess the upper side. I'm going to keep an eye on the upper side. Is closing the gap is one thing. Then we have the 100 to monitor for continuation and closing the distribution of these trades here. Something that could be very interesting to see as well. Because I say this because this is how the market has been behaving. This is the dynamic of the current market or the current cycle. I'll show you here. The market is using this. The market is using these areas. This areas of volume here. This is over. This is history. This remains in the market. Another one would be this area, for example. All down the road. This is another area. This is history. This level is history now. This is another. What happened, for example, the market is down here, right? The market is up here. Very close to this. Very close to this. It closed it outside this range. It didn't close it. It didn't close. If I am going to take a short or be short in this market, first why I would be short, right? Why I would be short here? I understand the risk. If I want to see something happen, the first thing the market will need to do is coming back inside this range. The next thing, coming back inside this range here, this 4-day range here. Zooming in, I have, for example, right now, all of these longs here are underwater here. Market is going to open at 6. These are underwater now. But I want to see continuation. The next thing the market needs to see is taking this range out, this area out. What can happen, for example, if the market opens down here or down here or down here? all of this inventory here in the upper side is going to be underwater. And what are the odds that this longs here is longer or higher time frame capital? What are the odds of that being the case? We understand that that the odds are low, that the odds are high, that the participants of this market, that the vast majority of these longs here are short time frame traders, because we have seen the market being bought from these lows, right? From these halfbacks, no excess here, halfback, no taper here, halfback, a little bit of taper here. But we may have some taper here, but there's potential for a firecracker effect here. Just imagine what can happen if the market comes down close to this area, which is the high of the 5-day range, and get close to this low. There's a bunch of stops here, 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 a lot of longs, weak longs here. Now the market can come all the way down to here, really, really quick. That's one thing. That's one scenario only. What happens if that doesn't happen? So you need to have, or I need to have another scenarios on mind. You know? One of the things that I try to do is I try to remain as neutral as possible. The market can be super high, super low, super long, or super short. I try to remain neutral. Okay? I try to remain neutral, and when you remain neutral, you can actually see things. How to try to picture that, I can give you an example. More likely you are a fan. More likely you may like some kind of sports, football, basketball, or baseball, or maybe some kind of music, or some kind of you may follow some actors or whatever. You may more likely that you will like something. Just let's assume, let's go just in the sports. I like football. My team is who's my team? The Kansas City Chiefs. I am a crazy fan about the Kansas City Chiefs. Right? I love Kansas. I love Patrick Mahomes. I love KC, and I love how they play. But I am a fan. I am a fanatic of that team. And when they lose, they play, I am so focused on what they are doing that I cannot see what the other team is doing. They might be playing against a really good team, a really good football team. They may be playing really nice football, but I don't see that because I am so focused on what I like. That's my bias. The other team can be playing better, but I feel of emotions. I start feeling bad that my team is losing. But I don't see the greatness of the other team. When I am neutral, I went through that process. I was super fan of one team, and I realized I was, when my team won, I was happy, and when my team lose, I feel bad. Why is that? So I started to. I still have some teams that I prefer over other ones, or another ones. But I start to enjoy the game. I can see the good things on my team. I start to see the good things of the other team. I start to see the mistakes of my team. You actually kind of like start to have a broader view of the game. And there's more things to see, and that kind of phenomenon happens in trading as well. When we get so biased, or when we look so close, we just see the market. If I see this, we see the market going higher and higher. Oh, okay, this market is going higher and higher and higher. Keep going higher. I'm going to be long here. I'm going to be long. But what I do is I miss context. Alright, I miss the content. I'm missing the bigger picture, and the bigger picture helps me actually to understand what is happening now. It helps me to understand, what kind of odds I have. It can help me to understand I am going with the market. I am trading against the market. For example, those are two simple things. If I am trading against the market, I understand that my trade have to work really fast. If it doesn't, if I am going to play something against the trend, I need to get out really fast. Something like that happened here. I did multiple shorts here, and my stop was 2 ticks. What was my stop? Was 4 ticks, something like that. I mean, this is two. My intervals are two TPOs. 2 times 2 p. It's not single ticks. This is double ticks. So 2 ticks here are actually 1 point. Right? My stop was 1 point. I wasn't going to be willing to keep the market too much long here. But that is to take that trade. To take this trade at the closing. I would never did that on Wednesday or Thursday of this market. Never would have done that. And I did that because I saw this market super hyper extended here to the upper side. I was also watching where this market closes. Right? It's going to close inside. The main thing is going to close inside this day. It closed above. The saddle was high, but the last was very close to this low here. I don't know if this even did the market. Oh boy, look at this. The market came back inside this range, but it last was outside. 80,000. Let me save that number. That's what I do as well. That's something I check. Notice how the volume drives here as well. 80, 37. Notice how the volume decreases, right? 16, 19, 13, 13, 12, 17, 17. Let's really see. I mean, it's not that bad relative to these days here, but it's not that great as well. So what I also look is this. I pay more attention to the overall volume, the market, and sometimes I look at the years as well. Volume was decreasing in the overnight as well. Now there is a lot. Let's check. Oh, my bad. Notice this. There's some. This market is super weak here. The inventory has not been revisited here. I mean this. Oh, by the way, this. My bad. Inventory. The overnight inventory was fairly rebalanced when it opened here. It doesn't have too much relevance. This one. This day was different, for example, than this one here. So I am going into the week. I am completely neutral. I think that the market is super hyperextended to the upside, to our upper side. The structure now is even weaker than it was before. A very mechanical trade, but I want to see some, unless I see some signs of exhaustion, I have to trade very careful here. Moody downgrading the US is one thing that may see. I didn't see the reaction of that to that yet. I want to see the opening today would give us some light here. The market did not close this gap here, no? But added another weak level to this area. Now, this is where the current contract opened. That's something else that I've noticed. This is the mechanical part of the trade, no? Of the market. Let me see. Let me show this. You know, the previous contract, June, where was June? Open here and close it. Can you see where it closed it? Right where it opened. Now, I'm not saying nothing here, right? But when this contract is open, we still have one more to go. Okay, can go higher here and come down here and close it again. Is that going to happen? I don't know. But those are things that, you know, okay, what if, right? You start thinking of scenarios, right? What keep those scenarios relevant is what the market does. If the market doesn't play or doesn't pay attention or doesn't or my scenarios does not fit the market, don't fit the market, I just discard those scenarios. But I always thinking, I always using the imagination here to try to get some understanding of what the market is doing at this moment in time. Now, the next thing I do is, I guess that's it that's all I have to say. The next thing I do is I check Jim Dalton's.
The week ahead.
I check Jim Dalton's.
The week ahead.
Come on. Market update. And that's what they're going to do now. Okay, let's hear what he has to say.
The week ahead. Overall, the underlying structure of the market is very weak. You always want to be aware that the person making this recording is biased to the short side. My bias relates to very weak underlying structure. At a minimum, this market needs to break before it can rally further. At the same time, it appears that laggard momentum traders are still able to take prices higher. Yield/interest rate focus is heightened once again. Government funding with a potential shutdown at the end of the week could create volatility, no matter the final outcome. Remember, markets hate uncertainty. We have yet to see the reaction to Moody's downgrade, which was the third of the rating services to downgrade, our debt. Tuesday's release of CPI will likely be closely monitored. My key ES level is 4,400. Holding that level keeps the recent advances on sounder footing. Failing to hold the 4,400 level quickly increased the odds that there is more serious liquidation to follow. For those wanting or seeking further meaningful upside, the best case would be for a break first to chase out some of the weak inventory. Have a great week.
Hi everyone, please join us for a live market webinar on Wednesday at 9 a.m. Eastern. The webinar sign-up link is in the description below. Early bird pricing for the live market profile permanent review, narrating the live and want to month free later. And we will also have a couple of webinars to help students get set up properly so that their charts mirror Jim's.
Okay, there is something that Jim has mentioned that I forgot is, and this is the potential of the government shutdown. the house need to come with something here, some funding before Friday, and that is something that can bring some volatility for the market. I was thinking something like buy the normal sell the news event, something like that. What he say is, regardless, what he said that I think he said that, but in different words, right? Regardless of what the outcome of that struggle in the house is the market likely will have volatility, right? That's something else that I have to be very aware also. That's going to be very, very present in the news during this week, the potential market shutdown. Something else that I have not made is I didn't check my market. All right, this is also something that I do every day. Now, we have, for example, on Tuesday we have this Chairman Powell here, the reaction. The bonds breaking here and closing lower on Friday. What's happening with crude? Crude is recovering here, and most important than this, the intraday is my daily charts, right? We have a gold falling or trending lower, and also this is look at this trend here, right? The mechanical selling here, right? The short covering and down this, and this very weird what's happening in gold here. And I watch gold because this is associated with recession. Dollar is having some rebalancing here. It's kind of like you have high here, low here. It's kind of around the half, around the center. I don't think it's that relevant, at least now. It will be something it gets closer to the highs or closer to these lows down here. Crude oil also. This is something crazy here. This level, the 67, I don't think this is good here. This is, but that would be just the technical side here. Just looking at the charts here. And what is more interesting here, is the background or the underlying of this trade or this market is if the economy is good, crude prices should remain high, especially when we have these conflicts and geopolitical situations in Ukraine. We have Israel, what's going on, and regardless of what's happening there, even also Russia and Saudi Arabia are announcing cuts or extending the cuts for longer. The market didn't care. The market just keep breaking here. Well, this commodity is not reacting to that. They're not expecting higher prices, and that could be maybe because there is some data there. Remember, all this is a speculation. I don't know anything about this market. I don't have information, enough information on this. But if this price keeps falling, then there might be some signs, right, that the economy is slowing. The world, China, United States is slow. Bonds, you have support. This is not rare. You have this rally, this short covering here comes to this exact level here. This is weird. It seems like it has potential here to the upside yet. There's some rebalancing here. We have a gap. The market was sold from the gap, and now we have a gap on the lower side. There's no resistance here. If you see this market here, this is the 10 years. There's no resistance here. There's a void here. And what we have below? Nothing. This is a very, very extended market. I don't have the profile of this. I don't have the intraday of this day here. I don't have market profiles here. But there could be something here also, no? I thought, that what I thought was the bond market is kind of like far from this low, but suddenly, yeah, and this is what trading is so, there has so uncertain, right? Out of the blue, there comes something, you hear something, and everything changes. And now you have Chairman Powell speaking, saying that everybody was assuming that there was not going to be more rates increases, that the Fed was done with that, and just suddenly he comes and speak that we are not done. The Fed may have something else in the box, right? A couple rates increases down the road, and boom, voila, you have this break that takes all these loans, take this market out. Also, something that he said is this is not healthy. Absolutely, the market needs to break some. For a good rally to sustain something sustainable is this market closing maybe one or maybe two gaps, so it can keep going. It can go going high. Not doing that is absolutely, it's just too weak, man. This is not healthy. The odds that it's going to collapse at one moment or other are keep increasing the higher it goes, the lack of sideways trading or even some pullback here. Right? This low was weak and now it's even weaker. Right? This wasn't good, now it's not better. It's really bad. That's what he said. Okay, I hope I can be tomorrow as well before the opening. I wish you guys, if I don't, I wish you guys a good week. Stay safe, enjoy the rest of the weekend, and happy trading. See you. Enjoy your weekend. Or what is left of. Bye bye.